Happy Friday, everyone. When market chaos hits, that's when we need clarity more than ever. The good news is that the data under the surface actually tells a very clear story about what's going on with equity markets. We know that variables like economic growth, banking sector stress in the wider credit markets, Fed rate expectations, we know that all of these impact equity markets and indeed all asset classes. The application of data science, maths, and computing power can untangle this and provide really useful insights into what's really going on. So let's do this. The machine indicated quite clearly in December last year the big drivers of equities had become economic growth, stress in the credit market, and interest rate uncertainty. So what was really interesting around mid-February was that the machine started to show that the credit stress underneath the surface was starting to rise. And that's the machine taking all the information that explains credit stress, updating that, and showing us the macro-based credit stress level, the fair value of credit stress, or to be more specific, high-yield credit spreads, was starting to drift higher. And you can see that on the screen now. This red line shows you the model-based value of credit stress, and you can see that that started to rise from early February. Second, the drivers of equities included as a key factor credit stress. And so there was a clear hint that credit stress was probably going to increase in late February, and indeed we have seen that happen. Now, aside from credit spreads widening, the other thing we've seen over the last couple of weeks is a slowdown in current quarter US real GDP tracking. Now, about a month ago, Q1 US real GDP was looking like around 1.5% annualized real GDP growth in Q1. That has now declined to around 0.5% annualized real GDP growth, so barely positive growth, and this has had another negative impact on the macro-based valuation of equities. Now, the next chart is quite important, and you can see it on screen now, and this shows the macro-based valuation of the S&P 500. And you can see there was a big buy signal in early October, and that was driven by real interest rates dropping and credit spreads narrowing, so lower credit stress indicators. We can see that that started rolling over in January, and that led to a sell signal around 4,080. We then entered this long period of neutral, about 6 weeks, where the macro information taken all together was net neutral for equities. Now, just over a week ago, we started to see this macro-based valuation roll over. And what's really cool is that we can actually break this down into its macro pieces and find exactly what it is that has been causing this drop in the macro-based valuation of, in this case, the S&P 500 index. And what you see on screen now is what we call our attribution analysis. And this shows us over the last week the various contributions of different macro factors to that decline in the S&P 500 model value. And what we can see far left is that the biggest contributor came from, indeed, credit spreads, higher credit stress in the credit markets. We can also see that real GDP growth was a negative contributor. If you look far right, you will see there was actually a positive contribution from Fed rate expectations, and we know that these have come down after the banking sector issues last week. But the net effect remains that the macro momentum, the information-based momentum of the S&P 500 remains negative. So what's the outlook? Well, the key here, again, is economic growth and stress in the credit markets. And the outlook for both of those isn't particularly rosy. So the net result is we can actually bring quite a bit of transparency to what's really going on in the equity market. I hope that was useful. Have a great weekend. Thank you.